Yeah, it's a very difficult situation for Beijing. They would love to stabilize sales, stabilize prices, and then eventually that would feed through to investment and you solve those liquidity problems at the developers. But they're unwilling to do these big bazooka stimuluses we've seen in the past because the real fear, and still the fear, is that if they go for an all-out easing on property, then the bubble inflates again and the problem is kicked down the road. So they're really trying to do just enough stimulus to stabilize sales, sentiment, and then bring up liquidity and investment for the developers. But so far, it's not enough. So they're holding back on these big stimulus measures, drip feeding, increasingly strong measures, but still not enough. And that's really key. We need to see broader national easing on property, and I think that does come in the Q4.
How much of what China is going through right now is cyclical versus structural? And when I talk about structural, I'm talking about things like declining population, high leverage in the system, high level of home ownership already. These are issues that cannot be changed with a bit of fiscal stimulus here and there. So does this not mean that the overall landscape for the Chinese economy going ahead is actually structurally a lot lower than it was in the past because of these issues?
That's right, Jumana. And structurally, we talk about the three Ds facing China: debt, which is mainly property, decoupling, and demographics. And these are three very large structural headwinds that will weigh on growth for the next 5-10 years at least. So China is really at the start of a post-COVID structural slowdown. But this is what we think is going to be a grinding slowdown, not a collapse, but a gradual decline, with property being the main driver, knocking between 1 to 2 percentage points of potential growth for the next couple of years as the sector resizes and restructures. Cyclically, I think it is a different story, and we're still seeing a lot of the COVID scarring for households, for local governments, and for banks really weighing on cyclical activity. So there is scope for a cyclical upside around this grinding structural downturn that lies ahead.
Well, I was going to actually ask you about one point in your report, because you say the risk reward on China equities is continuing to improve. Would you therefore, from a cyclical perspective, look to be increasing your weight exposure to China now?
Yes, we've just upgraded China equities in our asset allocation last week, and we think the risk reward is improving. It, as we said, bottoming out probably in Q4, and we're seeing that in the macro data, but also crucially in the stimulus stance. So it is getting much more proactive. It's still, we think, not enough, but the shift from a relatively contractionary fiscal and monetary stance in H1 to something more expansive has been made. And that signals a couple of things. First, the economy is much weaker than the headline suggests. It's not a good thing if Beijing is panicking and having to resort to stimulus. But second, which is where we come to our upgraded China equity outlook, is that eventually the stimulus, with a long and variable lag, causes the real economy to bottom and the markets to bottom a month or so before that. So we have upgraded China equities.